Hello fellow traders, I'm here to guide you through the exciting world of investments by comparing two powerful tools, stocks and ETFs. By the end of this video, you'll understand how these assets work and how to use them to achieve your financial goals. Today we're going to get into mastering investments, stocks versus ETFs by a pajama trader. Let's get into it. What are stocks? Stocks represent ownership in a single company. Returns come from price appreciation and dividends. Example, buying shares of Apple means owning part of the company and benefiting from its growth. Stocks are like owning a piece of a company. For example, if you believe in Apple's future, you can buy its stock and potentially profit as it grows. But remember, success depends on the company's performance. If it struggles, so will your investment. What are ETFs? ETFs are baskets of securities that trade like stocks. They offer diversification by holding multiple assets in one fund. Example, the SPDR S&P 500 ETF Trust, the SPY, tracks S&P 500 stocks in the index, giving exposure to 500 of the top U.S. companies like Microsoft, Amazon, and Tesla. ETFs simply investing by bundling multiple stocks in one fund. For instance, the SPY is an ETF that mirrors the S&P 500 index. When you invest in the SPY, you're essentially investing in America's largest companies without picking individual stocks. Example, SPDR S&P 500 ETF Trust, the SPY. Let's look at the SPY as an example. At the time of this video, it was priced at $599.37. It recently hit an all-time high of $610.78 just last week. By investing in the SPY, you get exposure to all 500 companies in the S&P 500. A great way to diversify without buying each stock individually. The current price, January 29, 2025, it was $599.37. The 52-week high was $610.78 on January 23, 2025. The 52-week low was $483.80. This tracks the S&P 500 index, which includes companies like Apple, Google, and ExxonMobil. Key differences between stocks and ETFs. Ownership structure. Stocks give direct ownership in one company. ETFs provide exposure to multiple companies within one investment. 2. Diversification. Stocks are concentrated investments. ETFs spread risk across many holdings. 3. Risk profile. Stocks carry higher individual risk. ETFs reduce risk through diversification. 4. Fees and costs. Stocks typically have lower ongoing costs. ETFs charge small annual fees, expense ratios. Stocks and ETFs are different purposes in your portfolio. While stocks offer higher growth potential tied to individual companies, ETFs like SPY reduce risk by diversifying across hundreds of different assets. Why choose stocks? Higher growth potential. Individual stocks can skyrocket if the company performs well. Example, Tesla's growth over the recent years. Direct ownership. You can have voting rights and direct exposure to a company's success. Flexibility in trading strategies. You can focus on specific industries or sectors based on your research. Stocks are those who want to control and are willing to take higher risk for potentially higher rewards. For instance, Tesla investors saw massive gains during its rapid expansion, an opportunity not available through most ETFs. Why choose ETFs? Diversification made easy. With one purchase, example, SPY, you gain more exposure to hundreds of companies. Lower risk compared to individual stocks. Reduces the impact from poor performance of any single company. Cost efficiency and accessibility for beginners. Low expense ratios make ETFs affordable for long-term investing. ETFs are perfect for beginners or those seeking to steady their growth with less risk. For example, SPY provides exposure to the top U.S. companies while spreading out risk, a safer option compared to betting on just one stock. Risks associated with each asset class. For stocks, volatility tied to an individual company performance. It requires extensive research and monitoring, and higher potential for significant losses if the company underperforms. For ETFs, example, SPY, still subject to market-wide risk, example, economic downturns, may slightly underperform their tracked index due to fees, tracking error. Both asset classes carry risk. While stocks can be volatile due to company-specific issues, ETFs like the SPY can mitigate this risk but remain vulnerable to overall market trends. When should you choose each? Choose stocks if you're confident in analyzing individual companies, you're seeking higher returns and willing to accept higher risk. Choose ETFs if you want diversification with minimal effort and you're looking for steady growth over time with moderate risk. Your choice depends on your goals. If you enjoy researching specific companies and taking calculated risk, I fall in this group. Go with stocks. If you prefer simplicity and lower risk, start with ETFs like the SPY. Conclusion. Both stocks and ETFs have unique strengths. Use them strategically. Example strategy. Combine both by holding individual growth stocks alongside diversified ETFs like the SPY for stability. Stay informed about market trends and adjust your portfolio as needed. My simple advice, use both tools wisely. Pairing high growth stocks with stable ETFs like SPY can help you build a wealth while managing risk effectively. If you found value in this video, give it a like, share with other traders looking for a trading edge, and consider subscribing for more market alerts and market edge videos like this one. Thanks for watching.